Hey friends, today we're diving into ST Engineering's incredible stock performance, which has been breaking records and outperforming major blue chips like DBS this year. Most investors think finding a blue chip that delivers both stability and explosive growth is nearly impossible in Singapore's market. But ST Engineering is proving that wrong with its impressive 41% share price surge this year alone. I've been tracking this company closely, and their 5-year growth plan shows why smart money is flowing into this stock right now. Let me walk you through exactly what's happening and why it matters for your portfolio. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with something really interesting. The analyst community is buzzing about ST Engineering right now. Major firms like RHB and CGS International have dramatically raised their target prices for the stock. RHB bumped their target from $590 to a whopping $780, while CGS International increased theirs from $560 to $740. Both are maintaining strong buy ratings. Why are analysts so bullish? It comes down to the company's ambitious 5-year plan. During their investor day on Tuesday, ST Engineering announced they're aiming for $17 billion in revenue over the next 5 years. Even more impressive, they expect their net profit growth to exceed revenue growth by up to 5 percentage points annually. That's the kind of profit acceleration that makes investors sit up and take notice. Think about it this way. If a company grows revenue at 10% but profits at 15%, they're becoming more efficient and valuable with each passing year. It's like upgrading your car to one that not only goes faster but also uses less fuel. Who wouldn't want that? Now let's look at what's already happened this year because the results are pretty mind-blowing. ST Engineering has been one of the top performing blue chip stocks in Singapore, with its share price surging up to 41% this year alone. That's not just good. That's exceptional performance for a blue chip. The stock has been consistently breaking through price barriers. It smashed through this $5 mark on February 7th, then powered past $6 on March 4th. Just last Thursday, it hit a historic intraday high of $6.93, up 0.36 or 5.5% from the previous day's close. By the end of that trading day, it closed at $6.91, a gain of 0.34 or 5.2%. To put this in perspective, imagine you invested $10,000 in ST Engineering at the start of the year. You'd already be sitting on about $14,100, a gain of $4,100 in just a few months. That's the kind of return most investors hope to get in an entire year or more. But here's where it gets interesting. Is the stock now overvalued? According to Yahoo Finance data, ST Engineering's price to earnings, PE ratio, is around 31.1. That's significantly higher than other blue chip stocks like UOB, DBS, OCBC, and SIA, which have PE ratios ranging from 7.8 to 11.5. Does this higher PE ratio mean you've missed the boat? Not necessarily. Sometimes a higher PE is justified when a company has stronger growth prospects, and that's exactly what analysts are seeing with ST Engineering. Here's where things get really exciting. Both RHB and CGS International predict that ST Engineering will benefit tremendously from growth in its defense sector. This is the strongest catalyst that could drive the stock even higher. By 2029, the company expects revenue from its defense and public security division to exceed $7.5 billion. They're eyeing a potential international defense market worth $11 billion. What's driving this? Escalating geopolitical tensions in Europe and the Middle East, plus increased defense spending by governments worldwide. Think of it this way. When countries feel threatened, defense spending becomes non-negotiable. It's like home insurance. You don't cut that budget when you're worried about break-ins. This creates a very stable, growing revenue stream for companies like ST Engineering. CGS International analysts Kenneth Tan and Lim Soo Ki put it perfectly when they said, supported by a multi-year defense upcycle, we see a stronger and clearer earnings growth trajectory. They noted that ST Engineering's management plans to address the vast international defense market by strengthening partnerships and enhancing localization. What does localization mean for profits? The analysts believe successful localization arrangements could improve margins given the higher engineering value and lower transportation costs. They also highlighted strong order pipelines in both ammunition and vehicles. While defense is exciting, ST Engineering isn't a one-trick pony. Their commercial aerospace division is another major growth driver that analysts are excited about. RHB analyst Shekhar Jaiswal predicts that revenue from the commercial aerospace division could reach $6 billion with a 7% compound annual growth rate, CAGR. What's driving this growth? The expansion of airframe and engine maintenance, repair, and overhaul MRO services, as well as investments in next-generation composite aerospace structures. Think about the aviation industry for a moment. Planes need regular maintenance regardless of economic conditions. It's a regulatory requirement, not an optional expense. This creates a stable, recurring revenue stream for ST Engineering's aerospace division. And with global air travel continuing to recover and grow post-pandemic, the demand for these services is only increasing. Airlines are flying more hours, which means more maintenance requirements. Plus, many airlines delayed maintenance during the pandemic, creating a backlog of work that benefits companies like ST Engineering. Does this remind you of anything? It's similar to how healthcare companies benefit from non-discretionary spending. People need healthcare regardless of economic conditions, just like planes need maintenance regardless of airline profitability. This creates business stability that's highly valuable in uncertain economic times. Now, let's talk about valuation, because this is where many investors get stuck. Yes, ST Engineering's PE ratio of 31.1 is higher than traditional Singapore blue chips, but both RHB and CGS are now valuing the stock based on 2026 forecasts to better reflect its long-term growth potential. RHB maintained their near-term earnings expectations, but justified their target price increase by looking further ahead. We are now valuing the stock based on 2026 forecasts to better reflect its long-term growth potential, said Jaiswal. He added that the new target price includes an unchanged environmental, social, and governance ESG premium of 4% over the fair value of 750s. This forward-looking valuation approach makes sense when you consider the company's growth trajectory. If ST Engineering delivers on its 5-year plan, today's seemingly high PE ratio could actually be quite reasonable. Think of it like buying a growing fruit tree. You might pay more upfront than for a mature tree with fruit already on it, but in a few years, your growing tree will produce much more fruit annually than the mature one ever could. The market's response to ST Engineering's plans has been overwhelmingly positive. On that Thursday, when the stock hit its record high, trading volume was massive, 8.9 million shares by mid-morning, growing to 12.6 million shares by early afternoon. This kind of volume shows strong institutional interest, not just retail investors getting excited. When big money moves into a stock with this kind of conviction, it often signals the start of a longer-term trend, not just a temporary spike. By 2:08 p.m. that day, the share price had retreated slightly to 684, still up 0.27 or 4.1% from the previous close. This kind of intraday stability after a big morning surge suggests investors were buying to hold, not just to flip for quick profits. Have you noticed how some stocks surge and then immediately crash back down while others maintain their gains? The difference often comes down to the quality of the underlying business and the type of investors buying in. ST Engineering's price action suggests quality investors making conviction buys. When we compare ST Engineering's performance to other blue chips this year, the difference is stark. While banks like DBS have performed reasonably well, none have matched ST Engineering's 41% year-to-date gain. This outperformance raises an important question for portfolio construction. Should you diversify across different blue chips or concentrate more on the strongest performers? The answer depends on your risk tolerance and investment timeline. But ST Engineering makes a strong case for increasing allocation to the best performing sectors. Think about your own portfolio for a moment. Are you spread too thin across too many average performers? Sometimes it's better to have more concentrated positions in your highest conviction stocks, especially when they have multiple growth catalysts like ST Engineering does. So what should you do with all this information? If you already own ST Engineering shares, the analyst upgrades and strong performance suggest holding might be the best strategy, despite the higher valuation. The company's 5-year growth plan provides a clear roadmap for continued appreciation. If you don't own shares yet, you might consider starting a position on any pullbacks. Stocks don't go up in a straight line, and even the strongest performers have down days that provide better entry points. To wrap things up, ST Engineering has transformed from a steady blue chip into a growth powerhouse, breaking records and outperforming the broader market. The company's ambitious 5-year plan, strong analyst support, and multiple growth catalysts in defense and aerospace make a compelling case for continued success. The stock's 41% year-to-date gain and consecutive price level breakthroughs show tremendous momentum. While the higher PE ratio of 31.1 might give some value investors pause, the forward growth prospects justify this premium according to major analysts. Remember that investing is about looking forward, not backward. ST Engineering's management has laid out a clear vision for the next 5 years, and the market is rewarding that clarity and ambition with a higher share price. What do you think about ST Engineering's performance? Have you been riding this wave, or are you considering getting in now? Drop your thoughts in the comments below. I'd love to hear your perspective on this Singapore success story.